You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by Purepoint Uranium Group. Purepoint advances discoveries through strategic partnerships, working alongside industry leaders, including ATHA Energy, Cameco, Orano, and Foreign Mining. Drilling is underway right now. And now, your host, Chris Frostad.
It's February 10th, 2026, and this week on Uranium Spotlight, spot prices retreat after extreme volatility. Long-term supply tightness hardens further. Central Asia moves to secure its own uranium future. Kazakhstan deepens the east-west divide in nuclear fuel markets, and ATHA Energy emerges as one of the best capitalized uranium explorers globally. The uranium spot price opened last week at $98.60 a pound U3O8 and closed the week at $85.70, marking a sharp pullback after briefly trading above the $100 level earlier in the month. The move highlights just how thin and reactive the spot market has become, particularly when financial participation pulls back even modestly. Despite the price decline, underlying conditions remain tight. Spot availability continues to be limited, with most material tied up in existing commitments rather than offered freely into the market. As a result, marginal buying and selling continues to produce outsized price movements. Importantly, this volatility has not altered longer-term procurement behavior. Utilities remain focused on securing multi-year coverage rather than attempting to time the spot market. That preference reflects concern over future availability, not short-term price weakness. For investors, the key takeaway is that spot volatility should not be mistaken for easing fundamentals. The market remains structurally tight, and sharp price moves are a symptom of limited liquidity rather than excess supply. Last week, veteran uranium market analyst Jonathan Hines outlined why the uranium market remains on track for further tightening and a prolonged structural supply deficit over the next 3 to 5 years. His message was clear: demand is accelerating while supply continues to fall and lose flexibility. One of the most important signals he highlighted is the growing dominance of the long-term market. Most uranium is purchased through long-term contracts rather than the spot market, and last year the long-term price moved above the spot price. That inversion is rare and meaningful. It signals utilities prioritizing security of supply over price discovery. Spot prices have also risen sharply in recent weeks, peaking above $100 a pound before pulling back. This has occurred as stockpiles continue to be drawn down globally. As inventories shrink, incremental demand will increasingly struggle to find available supply. The core issue, as Hines framed it, is that the problem is not improving. Without meaningful new greenfield production, the structural deficit does not stabilize. It grows. Restarting idle mines and incremental expansions are not enough to offset declining legacy production and rising reactor demand. For investors, this matters because it reinforces that uranium's supply challenge is both immediate and persistent. The market is no longer debating whether a deficit exists, but how severe it becomes. Uzbekistan reported record uranium production of 15.4 million pounds in 2025, a notable achievement for the small Central Asian producer. The country now accounts for roughly 10% of global output and has announced plans to increase production further by developing 4 new mines. However, the broader implications are more complex. Uzbekistan holds approximately 300 million pounds of uranium reserves, modest relative to major producers like Kazakhstan and Canada. More importantly, much of its future production is likely to be consumed domestically as the country builds new nuclear reactors. Those reactors will be built with Russian involvement, and while initial uranium may be mined locally, fuel processing and fabrication will take place in Russian facilities. That structure effectively ensures Russian access to Uzbek uranium while limiting availability to Western utilities. With more countries building reactors and prioritizing domestic supply, uranium that might once have flowed into the global market is increasingly being retained at home. For investors, this highlights a key shift. New production does not automatically translate into exportable supply. In many cases, it simply reallocates material away from the open market. Kazakhstan took another step towards reshaping global uranium flows last week by approving its second large-scale nuclear reactor for commercial use. This follows approval of its first reactor last year, which is still in the survey stage with construction yet to begin. Russia's Rosatom will build the first reactor, while the second will be constructed by China National Nuclear Corporation, one of China's two major state-owned reactor builders. Chinese leadership on the second project has been confirmed multiple times. The implications are significant. Kazakhstan is the world's largest uranium producer, and China and Russia already purchase the majority of its output. These new reactors further entrench the relationship and make it increasingly likely that Kazakhstan's uranium will remain within Eastern supply chains. Western access to Kazakh uranium is already constrained. The United States has banned imports of Russian uranium and nuclear fuel, and the European Union has considered similar measures. Even where sanctions do not apply directly, logistics, political alignment, and fuel cycle integration limit Western participation. Without new Western greenfield production, which given geology would most likely need to come from Canada or Australia, Western utilities face a structurally higher price environment than their Eastern counterparts. And with regulatory barriers still limiting development in Australia, Canada increasingly stands alone. For investors, this reinforces that uranium is no longer a single global market. Pricing, availability, and risk are diverging along geopolitical lines. ATHA Energy last week detailed its post-financing plans following the completion of approximately $63 million in combined financings, including a strategic investment from Queen's Road Capital. The scale of the financing places ATHA amongst the best capitalized uranium explorers globally. The proceeds will be directed towards advancing ATHA's 100% owned Angilak uranium project in Nunavut. Planning is underway for the 2026 exploration program, expected to be the largest ever conducted on the project. The 2025 campaign delivered 5 new uranium discoveries within the Angakuni Basin, in addition to the Lac 50 deposit. Those results materially de-risked the project and helped attract strong institutional backing. In response, ATHA is preparing to mobilize an additional diamond drill, with full mobilization scheduled for March and drilling expected to begin in late April or early May. Exploration in 2026 will focus on expanding mineralization at Lac 50, which hosts a conceptual exploration target of 60.8 to 98.2 million pounds at grades of 0.37 to 0.48% U3O8, while also advancing multiple discovery corridors and greenfield targets across the basin. The program will combine diamond drilling, aerial geophysics, and surface mapping, with additional technical detail expected later in the first quarter. For investors, the key takeaway is this: ATHA now has the capital, momentum, and scale to pursue discovery aggressively. In a market increasingly focused on future supply, well-funded explorers with demonstrated results stand to attract disproportionate attention.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global landscape, sponsored by Purepoint Uranium Group. While our passion for the sector is undeniable, remember that nothing discussed here should be taken as investment advice. Our goal is to provide a clear and balanced view of the factors affecting the uranium price. Join us again next Tuesday on Uranium Spotlight.